Welcome back to the Behind the Well Show. Your host, Roger Abel, here with Elias Randall. And today we are going to talk about the 7 ways to level up your investing strategy. With that said, welcome back, Elias. Looking forward to today's show. Anything new happen in your world?
I'm ready to level up.
Level up, baby. Yep. We talk about it all the time. And I think level up, it's just kind of a fun title, but really it's just 7 really great ways to advance your investment strategy or to incorporate it into what you're already doing. And I think the first thing we're going to talk about here is how to optimize for risk and return. You know, this is actually formerly known or currently known as modern portfolio theory. And really all that is that, you know, each investment has if it has a higher potential for return, it comes with a higher risk. But how do we actually optimize the risk and reward to get somebody to where they need to go?
There's a few basic things. So with investing, if you really want to simplify it, what are your goals for the money and what's your risk tolerance? Right? That's a good starting place. And that's a good way to balance the risk and reward, just understanding that, because there's inherent risk with any type of investing, right? So understanding your relationship with money, how account fluctuations are going to impact you, and what you need to do to optimize your situation, which, okay, if I'm 28 years old doing investment accounts for retirement, well, my strategy, the investments I buy, probably going to be different than someone who's 68 years old and has income needs from their portfolio. So you can really start to craft it with just a few basic questions to help you get pointed in the right direction and know which way to go.
Well, and what we do is we take what you mentioned, what are the goals? What's the risk tolerance? But then we take that financial plan and figure out what the risk capacity is. And I think risk capacity for a lot of people, if you've been listening to our show for a long time, you know what it is. But if you're new to this show, you may not know what risk capacity is. And that's simply how much risk do you need to take to accomplish your goals? And it's vastly different than risk tolerance, because risk tolerance is just, how can I handle the ups and the downs? Doesn't really matter. Risk tolerance doesn't factor in your goals. Just says, well, if the market goes up, I feel good, or the market goes down, I feel good. That's what that is. Risk capacity is incorporating those goals into it. So we might have an individual who's 60 years old and retired, and their risk capacity is a 70% stock, 30% bond asset allocation. Not aggressive, okay, but not up what we call balanced either. Their risk tolerance might be that of a 30% stock, 70% bond portfolio. So there's a disconnect. Their inherent how they feel about investments and what they need to do to be successful are different. And our job is how do we blend those two together to get them the optimal outcome? Because if they stay in the 30% stock portfolio, they're not going to be successful. So when we talk about how we optimize a portfolio, it's really, like you said, goals, risk tolerance, and risk capacity, and bring those together to craft a really individualized, specific portfolio for people. And we'll talk about, as we go through the 7 ways to level up today, like how you incorporate technology to do that, because that's the one thing you need to have to really level up. Also, when we talk about, risk reward, one of the key things people can do, and this is probably going out to everybody who has a 401k, rebalancing your portfolio. It's really important. It becomes more important the later stages of life. Like you said, when you're 25, you're probably all growth. There's a limited amount of rebalancing that should be happening, because you're probably not going from 100% stock to 80% stock in a year if you're 25. But the later you get in life, rebalancing becomes more important. And here's a cool thing about rebalancing. It's really just buying low and selling high in relative fashion.
Please
you're selling
explain.
Your winners. Well, think about rebalancing. So you start with the 50% stock, 50% bond portfolio.
Mm-hmm.
Market goes up 20%. Now you have 60% stock, 40% bonds. Doesn't mean that the bonds lost money. They just didn't appreciate as much as stocks. So you'd sell some stocks, you'd buy more bonds to get back to 50% stock, 50% bonds. Buy low, sell high. It's a relative low buy, right? Doesn't mean they went down. We're just buying the asset class that didn't perform as well.
Right. And that's a lot of times that's a question I will ask people. And I'm sure that's going to be getting more and more, right? With the market back to close to all-time highs and people are wondering what to do. A lot of times I'll lead with the question, when was the last time you rebalanced your portfolio, right? Whether I could know a lot about their situation or just have very vague information, but they're asking me a question, that's a good thing to ask. When was the last time you rebalanced? Because that is an investment behavior that, right, you're forcing yourself to sell some gains in investing. Some things that are hard to do. Sometimes it's hard to sell your good investments when they're up. Why? You're greedy. I want to see if it's going to go up more. So it kind of forces you to be a good investor and, well, I'm going to take some of these chips off the table, reallocate those to these other asset classes. But over time, rebalancing should be a good way to help with your risk-reward profile or however you want to describe it.
Well, and you're kind of leading into how do we manage where these are risk management strategies you're mentioning, right? So rebalancing, but also you mentioned right now stock markets close to all-time highs. And I always hear this when it's at all-time highs. It's now a good time to buy. And in 10 years, you'll probably look back and be like, man, I wish I would have bought some. But if you're nervous about it, a good risk management strategy for this is just dollar cost averaging. You have, 50,000 you want to invest, put it in a little bit over time.
Yeah, and dollar cost averaging is maybe it's kind of what's the word? Underhyped. Underhyped, is that a word? But it's just an effective way to just keep buying, especially for accumulators, right? Trust me, if I knew exactly the perfect times to invest money, what would I do? I would do that.
Well, let me tell you, we probably wouldn't be doing this show.
No, probably not. Probably not.
We'd be doing a market timing show, and it just doesn't work that way.
Market timing. Yeah, but so for me, how do I dollar cost average? Well, in my accounts outside of 401k, it's just weekly. I like weekly contributions. It's easier to manage, breaking it down to that. 401k, we get paid on the 1st and the 15th or 16th, so twice a month. And those purchases, when you're dollar cost averaging, you're not really price sensitive because it's just systematic and automatic. So I'm sure some of those look like very poorly timed buys, and some of them probably looked like great timed buys. But over time, it's all gonna work out. And in 10 years, and I'm not, at 36, I'm not concerned about my retirement one. I can't even really touch my retirement accounts until 59 and a half. Right. So I'm just going to dollar cost average in, and the purchases I make today, 20 years from now, it's not going to matter the specific timing that I got on those.
So that's one, optimize for risk and return. Two, and I think this is really a good one, take an asset specific approach. This is where you might use an asset class for a percentage of your portfolio, right? So stocks, bonds, real estate, commodities, those are all asset classes. When you start to put them all together, you start to eliminate some risk, right? When you have all these different asset classes together, it smooths the road out. But one of the things I thought about this is, we talk to people a lot about how you're not going to time the market. But that doesn't mean that we're not making changes in portfolios based upon market conditions. We're just saying we're not going to try to figure out whether we should be in cash or in stocks. We're going to keep a core portfolio and have thematic investments around it. Because anytime in the economy, different parts of the economy are going to do better than others. So instead of trying to guess if the market's going up or down, we'll be invested, but then maybe there's opportunity in certain parts of the economy. And you can be asset specific doing that, but it shouldn't take you away from your core asset allocation of stocks to bonds that was created by step one, which was figuring out what my goals are, what my risk tolerance is, and ultimately what is my risk capacity. This asset specific approach so leans into, okay, if I have a 70% stock portfolio, how much am I going to allocate to international?
How much? It's
well,
good
as of
question.
doing the show, tariffs take place tomorrow. So if you've been paying attention, you might have said, well, I don't run a whole lot of international exposure because I think there's going to be tariffs. Doesn't mean we're deciding whether to get in and out of the stock market. It's just where is the asset location within those stock funds? And that's not a plug for international, yes or no. It's just an example.
Well, and you could also, I mean, that's also right to a rebalance maybe isn't always what we described earlier, but maybe the percentage of your portfolio that you do have in stocks, maybe you're going to rotate that to a different industry or a different sector, right? There's also like you can rebalance even your specific asset classes too by if you look and if your outlook is very strong on just for example the healthcare sector, you could go buy an ETF that tracks that, right? If you think, I think the next couple of years are going to be good for that part of the economy.
So you take part of your stock allocation and you're saying, hey, I want a small sleeve of this sector specific fund.
Yeah.
Here's another good example of this exact thing. You have a person retiring. They got $1 million. I'm just using an example. They need $40,000 a year of income. That doesn't mean you got to get out of the stock market, but maybe it lends itself to instead of only having growth, maybe I want enough dividend paying stock investments to cover my $40,000 a year I need. And then you can create that strategy. It doesn't mean you change your whole asset allocation. You just change the thematic theme of it and said, hey, I need income, so let's drive income from this thing. So that's number two. It's the asset specific type approach. Number three is tax efficiency. I think a lot of people underestimate this. And part of it is it's just so easy to say, yep, my employer enrolled me in my 401k, traditional side, and this is what I'm going to do. But there are ways to diversify your portfolio by tax efficiency too, which, depending upon where you are, depends on what you should do. And I don't want this to be a blanket statement because one thing I want to mention is that over the course of the last year, I can't tell you how many people have come in this office and said, I want to convert everything I have to a Roth IRA. Why? Well, I watched this video because right now, if you go on to social media, all you see is you should only have a Roth IRA. And that's not true. There are times where it makes sense, and there are times where it does not make sense for an individual to do all Roth or do a Roth conversion. So this is where you probably need some guidance from people in our industry to help say, hey, this is what makes sense for your unique situation. And then let's execute a plan around it.
Well, and with the increased popularity, certainly for Roth accounts, and if we're, the being tax efficient, and this is not just a blanket recommendation, but I think one of the benefits, one of the arguments to make for Roth accounts, 401k and IRAs is if your concern is to be tax efficient, well, there's no more future tax on those accounts. So that does simplify someone's situation because the money in those accounts, that's tax-free growth, tax-free distributions, and retirement. So it is a way to get some of your money, right, to a known tax code that you're never going to owe tax on it again.
I for sure think it's important, but there's so many people that have done these conversions that aren't really in their best interest. I'm 63 years old and I just hammered out $1 million Roth conversion at one time. Why? Because I watched a video and said I should have all Roth. When do you need the money? Well, I'm going to start taking distributions in 3 years. Really? Like, I've seen it happen.
Yes, that is right.
Like, it's not a blanket strategy. You need to have a personalized strategy when it comes to this. Also, you know, HSA accounts, health savings accounts, vastly underutilized to the people that have this available to them. And it's a really great way to provide for healthcare later on and accumulate. It's the only triple tax-free investment. Tax deductible going in, grows tax-free, comes out tax-free for health-related expenses. So just a couple of ways that, you know, we can be fairly tax efficient. And then, you know, a little bit of a tax efficiency is what you own. You know, I would tell people that 25 years ago, if you weren't buying an individual stock or an individual bond, you were buying a mutual fund likely. Well, with the advent of ETFs, exchange traded funds, for the most part, exchange traded funds are way more tax efficient than a mutual fund. You know, everybody who owns a mutual fund and a non-retirement account that has any value in it whatsoever, like significant value, understands the pain when your investment goes down 25% and you get a capital gain distribution, you still owe tax on the thing.
And that's one of the bigger differences of mutual fund and ETF.
Well, I think it's why ETF investing and separately managed accounts have gained in popularity. It's because of their ability to tax loss harvest. Go and select what we want to sell to offset the gains in the account versus, well, this mutual fund was down 20%, but they made all these trades in here, so I still owe tax in this account. It's just a much better way to control your tax situation. And you're not going to avoid taxes. I don't want people to think that having a managed account that has tax loss harvesting or owning an ETF is a way to avoid it. It's not a way to avoid it. You're still going to owe it if it goes up in value, which is what we all want. It's just potentially a better way to manage your tax liability.
I would agree with that because you do have more control on when you sell or I guess when you realize the gains, right? So in the ETF wrapper, like you just have more control of when you're going to realize a gain or a loss. And another thing I want to bring up on the tax loss harvesting conversation, because a lot of times this topic is really popular at the end of the year, like when all hey, here's things to consider at the end of 2025 or 24, whatever year it is. But this is really something that periodically you could be looking at your portfolio to harvest either losses or harvest some gains. Because if we have a big correction in the middle of the year, that doesn't mean you need to wait until the end of the year. You might not have that anymore. So I think it is a topic that should be top of mind, like throughout the entire calendar year and when you're making your investing decisions.
100%. I think that's underappreciated. And also, if you think about a diversified portfolio, obviously, if everything goes up in the world, you have all winners. But in most normal markets, there's going to be some winners and some losers.
Typically.
Like, it happens a little less when you're using a pooled investment like a mutual fund and an ETF, right? But if you had sector-specific ETFs, you run the risk of that one sector might not perform like the broad market. Well, if it's down, then you can sell it. Doesn't mean you have to be out of the market. You just sell that investment, take the loss, reinvest somewhere different. But it is a good strategy that we utilize with people who have managed accounts with us. And it becomes meaningful for people. And you can, like we mentioned, you manage your tax liability. Like, you know what your capital gain is going to be. What's your capital gain going to be from your mutual fund this year?
You'll get an estimate, but you won't know specifically what.
I was just waiting for you. You don't know till you get the 1099.
Right.
At least if you're buying and selling, you can say, well, I know my gain is X, so we can plan for that. Elias, the fifth way to level up your investing success is start to break down what different behavioral biases that we all have. And I think we're really familiar with this. The other day we were having a conversation on the phone about recessions, and you mentioned a bias.
Recency bias.
Recency bias.
Something I've been thinking about pretty consistently for the last year or two.
Or three, since everybody's been predicting a recession that never
Right.
happened.
Right. And I think it really highlights how events then form our thinking in the future. Because whether we've been through a recession, however you define it, I think we can all agree we've had some economic slowdown, right? And just in a broad term, that's really what a recession is, economic slowdown. But I think the last few years, I don't think investors and people have realized it's very similar. It's either is a recession or similar to one, because the last recession we had, 2008, that was really a crisis. That's why it's called the Great Financial Crisis. But that a recession can be pretty like, one, it's normal economic activity, and two, it can be fairly unpainful to get through. And I think this economic slowdown has been fairly unpainful to get through. For most people, there's people that it's more painful than others, but there's not just broad, the housing market collapsing and some of the biggest banks on the verge of bankruptcy. We're going through economic slowdown without that extra stuff that's very, very scary for our economy.
Well, and I think that's the easiest one to get sucked into is recency bias. We see it still in like home prices. People list a house, they still think it's 2022 and money's free. And then it sits in the market for a year. Why? Well, you still think it's 2022. It's not. People can't afford it.
Yeah, they still want to list at the price they could have listed a few years ago. And that's not, the new listing prices are just not that high.
Well, they are. They're just not selling. You can watch the market.
Right, which means they should come down a little bit.
I have a buddy who's a realtor. They're like, well, stuff that's newer, that's listed for the right price, it sells pretty fast because there's not a whole lot of inventory. But he goes, I can look around. This stuff's been listed for a year. It's because it's overpriced and people don't want to budge. And we had the conversation of whether the people that have those listings actually want to sell it, or they're just putting it out as, hey, this is what I would sell it for. There's a little property listed on a local lake, 0.25 acres. They have it listed for $950,000. Okay. Well, last year they had it listed for $899 and it didn't sell for the whole year. And the year before they had it listed for $799 and it didn't sell for the whole year. Clearly, that person, this is just a 0.25 acre lot. There's nothing on it. They clearly don't want to sell it. They're just throwing the price out and saying, hey,
that's what I would
sell it for. So there's real and not real listings.
That's just not a serious listing though.
No. The other thing is, I think another good bias that people really get sucked into, especially in today's day and age of information, because there's tons of it out there, is the herd mentality. We've seen this in different asset classes. Hey, if everybody else is doing it, makes it right. And it may or may not make it right. But a lot of times when we have the herd mentality, it results in big sell-offs. We just saw it in AI.
2022 is a great example
of
that.
No, just 3 weeks ago is a great example.
Oh, and when DeepSeek and all that.
When DeepSeek came out, when they released their news, we had energy companies, we had anything AI related was down 15 to 20% in a day. Well, why? Because the entire herd said, this is what it is. Got to get there. I had someone call me up and want to buy an individual stock. Sure. Your buy. It was down 20%.
After they purchased or?
After.
Whoa.
They bought this about 2 weeks before the DeepSeek. I got to get into the AI game. I got to get in the AI game. This is what I want to buy. Sure. Down 20.
So they did buy it.
Yeah, they bought it.
Still holding?
Yeah, they haven't called me either. So they're going to hold it. It's a good company. It's not a speculative company. It's a company that's been around for 30 plus years. It's not going anywhere, but I'm sure there's a little regret after because they were following the herd. Hey, I have to get in. Well, could get in at the wrong time. Now, that said, if he holds it for 20 years. That's probably a common
thing when a lot of people are saying, oh, I have to get in. That's Usually you've probably missed out on the
NFTs.
Yeah, you missed out on the first big rally because you didn't get in early enough.
Do you remember when we had
that was you felt like it was too early at that time, so you didn't
this happened about 2 or 3 years ago. We had someone come in and ask about they were asking about meme stocks.
Okay.
We're like that was over like a year ago, but they still wanted to do it because they read it on Reddit. Like they were trying to get in the herd at the end, and whether right or wrong, we don't know where the market's going to go, but it's a dangerous thing if you're just following the herd. The sixth way to level up, and honestly, it's not just individual investors leveling up, but it's advisors like us leveling up too. And that's utilizing advanced analytics and technology. And I'm going to give an example of how technology has changed for the advisor. And it's not that long ago. Number one, this little thing in my hand, this phone, I had this talk with my girls the other night. I said, do you know how long this has been around? And you know my kid said, forever, Dad.
Their whole life. Yeah.
Whole life. I go, no.
Which for them, that is the correct answer. It has been around forever.
Okay. That is true. For them, it's been forever.
Yeah.
Do you know what year the iPhone was released?
2006.
I think it's 8. But either way.
I was in high school. That's why.
Yeah, 2006, 2008 is when this is released. So we've had this less than 2 decades. And every single person listening to this, my guess is you're listening on an iPhone type device.
Probably.
At some level. Okay? So technology has changed. I remember this is in 2011, putting financial plans together. We would put a plan together. We had branded binders, leather-bound binders, Premier. You'd print the plan, nice presentation.
Sounds nice. I want one of those.
And we do a great presentation, and inevitably, here's what would happen. Oh, yeah, this is great. What's it look like if instead of spending $8,000 a month, I want to spend $10,000? We'll get back to you in a week. Went back, did all the work, put in their leather-bound binder, implement a financial plan. And they put it in the junk drawer like we all have, and it sits there. This is just 12 years ago. Today, what happens?
Just change the scenario.
You change the scenario.
And hit the button, and it tells us the answer.
Instantly. So when we calculate someone's risk capacity, there's no guessing involved. Right? If someone calls up and says, hey, I'm really nervous because the stock market went down 10%, what should I do? It's not us scrambling and doing all this work. It's literally just run the scenario and make sure their risk capacity is correct and aligned with their risk tolerance. That's it. That's all just financial planning technology. And for a long time, when people asked us, how do we know if we need a financial advisor? The answer was, well, do you have the time, the desire, and the knowledge to do this? We've now added technology. I had a meeting with an individual. This is probably 5 years ago. Maybe not that long ago. Maybe 3 years ago. 3 to 5 years ago. And he was very intelligent, engineer, wife ex-stockbroker from 30 years ago. So she still knew lots of stuff, or thought she did. And the husband was really smart. He could run all this stuff on spreadsheets if he really wanted to. And the spouse got up, went to the bathroom. And the husband looked at me. He goes, I figured out what you can do for me. I go, really? Share. He goes, you can become all the technology that I don't have. Because truth be told, between the spouse having a knowledge of general investing and his mathematic knowledge, they could figure some of this out. But he said that spreadsheet that I prepared took me countless hours. He goes, I just watched you put this together in less than an hour. And I can also see when we change one thing, how it changes everything else, and I don't have to recalculate. So for that family, we specifically became the technology.
Well, and he's right, because unless they're going to invest in financial planning software and learn how to use it and run all their own money, there's why wouldn't you just delegate that?
Well, and by the time you go get a decent software package, you're going to spend a few $1,000s. Well, how much are you actually paying this advisor? And here's the problem with getting your own software. One, you have to make sure it's inputted correctly. I could bring any new person in here, train them, give them a day to do it, and the first 10 plans they put in there, it's not going to be accurate. Right? Because I know, and you know, when we look at it, if there's something wrong, if something doesn't seem right or is amiss. So we're going to put this in the hands of the general public to assume that they can enter the information inaccurately and then know if the outputs are correct. Because if you put garbage into that computer, it's just spitting out garbage. And a lot of this is interpreting the data that comes out because it's just numbers until you do that. So technology has become such a really important part of the financial planning process because most of the questions people have can be answered by utilizing technology, but you still have to understand the inner workings of it and how different financial concepts all work together and make sense and whether the output of this is actually accurate or not.
Well, the interpretation of the data is probably the bottom line of technology, right? Like you got to, one, the data input has to be correct, and then interpreting it and understanding the moving parts. So here's a good example of a topic that has a lot of moving parts and gets brought up a lot, Roth conversions, right? If you don't have the technology to figure out, one, what are all the costs going to be associated with that decision? Because it's gonna realize taxable income. If you're Medicare age, depending on that, you could have increased premiums. And then there's also a break even of, is this decision even worth it for you as the investor, right? Like if it's your personal account, will you benefit from this in your life? That's another. So, okay,
well, how long does it take to benefit?
Could be 10. It depends on how much tax you have to pay.
Well, here's the thing no one's thinking about. What happens if I go over $206,000 of income and I have an IRMA where I have to pay more in my Medicare premium because I did it at 63?
You have to factor in all the cost associated.
The seventh way and final bottom line, if you want to level up your financial planning, your investment portfolio, is you need to work with some professionals. And a lot of it is the things we just talked about here. Do you have the technology to do it? Do you have the time to do it? Do you have the expertise to do it? And what financial professionals can do is help you optimize what you're going to be doing and make sure that, you know, your goals are aligned with where you want to go in the future and help answer all the questions that people really have about their financial future. Am I on track? What do I need to do to get on track? What risks do I need to take?
Yeah. What risks do you need to take? How can you protect your money? There's a lot of different questions that we can help answer for people. And I think that's, you know, I tell a lot of people we're in the business of getting our clients a successful outcome or an optimal outcome. You're going to have an outcome no matter what you do, right?
That's the motto of the show.
Yeah. Whether you do it yourself or you hire someone or a friend of yours gives you advice and helps you once in a while. So I think that's the big question is what type of outcome do you want to have? And go from there.
With that said, if you're looking for an optimal outcome, not just a regular outcome, feel free to click the link in the description to get started, or you can go to btwellshow.com. We'd be happy to help you. Once again, from Elias and I want to thank everybody for listening, and hopefully you keep tuning in the future.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments and Wealth Management and LPL Financial do not provide tax advice. Please consult your tax professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. There's no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure a profit or protect against loss. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure a profit or protect against loss. Consult your tax professional about eligibility to Roth and traditional IRA contributions. Contributions and earnings in a Roth IRA can be withdrawn without paying taxes and penalties if the account owner is at least 59.5 and has held a Roth IRA for at least 5 years. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of the conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a minimum distribution, RMD, in the year you convert, you must do so before converting to a Roth IRA.